Well, good morning, everyone, and thank you, President Dudley. So this morning, what I'd like to do is spend some time giving you an update on economic conditions in the region since our last press briefing, which was back in June. And I'm going to focus my remarks this morning on three broad areas. So first, with the anniversary of Superstorm Sandy, we're going to take a look back and see how the region's economy performed during and after the storm. And what I'll show you is that, in fact, the regional economy rebounded quite quickly from the storm's damage and disruption. After spending some time on Superstorm Sandy, I'm going to step back a little bit and talk about the broader regional economy and what's been happening more recently in terms of economic activity and employment. And what I'll show you is that New York City remains on a very strong growth trajectory. But when you look across other parts of the region, in particular upstate New York and northern New Jersey, growth there has been more moderate, and Puerto Rico remains quite weak. And then last, I'll wrap up with some thoughts on housing. And while most of the region's housing markets continue to improve, what I'll show you is that home price appreciation here has been below average during the housing recovery that's taking hold across the country. So let me get started here with some thoughts on Superstorm Sandy. So what this first graph shows is total employment in the New York City metro area for the first part of 2012. So the New York City metro area includes obviously New York City, but also Long Island, parts of northern New Jersey, really the affected area from Superstorm Sandy. What you can see is that we had growth underway, and when Superstorm Sandy hit, there was a downturn, lost about 37,000 jobs. And at the time, there was real concern about how deep this downturn was going to be and whether the economy was going to recover, and if so, how long it would be. So let me show you what happened since then. What you can see is that the regional economy rebounded quite quickly. Between November and December, there was actually an increase of 67,000 jobs, more than making up for the initial loss. And most importantly here, you can see that the economy quickly got back onto the trend line that it had established prior to Superstorm Sandy. Now, what's important to keep in mind here, though, is that even though the regional economy rebounded quickly, that does not mean that things return to normal, right? Many of the hardest hit places continue to struggle even today. Some of the jobs that were lost as a result of Superstorm Sandy never came back, and many of these jobs that were created were in response to the rebuilding efforts following the storm. So how does this compare to typical natural disasters? So what I've done here is I've just taken that employment line and I've just indexed it so we can look at employment up to 1 year prior to the storm. Here on this chart, 0 is when the storm hits, and then we've got roughly another year's worth of information for Superstorm Sandy, and you can see that growth continued. So how does that compare to other types of natural disasters? Well, two typical cases, Hurricane Andrew in Miami, the Northridge earthquake in Los Angeles. What you can see is that what's happening in our region is more or less following what's typically the case after a natural disaster. Now, at the time that Superstorm Sandy hit, there was also some real concern that the damage and destruction inflicted by Hurricane Katrina in New Orleans maybe would occur here. Right? So let's take a look and compare it to Hurricane Katrina in New Orleans. And what you can see here is that, in fact, the path here is quite different from what happened in New Orleans. All right, then lastly, in terms of Superstorm Sandy, at the time of our briefing last November, when we were trying to give some sense about the initial impacts, we showed you some information on school attendance. What you can see is 1 week following the storm, school attendance had dipped, especially in those most affected areas, places where the schools were either closed or relocated. But similar to the employment trends, you can see 1 month after the storm, in December of 2012, attendance had more or less returned to that typical level of about 90%. And 1 year after the storm, earlier this month, you can see that attendance is more or less back to normal, and there's really no difference between these two types of places. All right, let me step back now and talk a little bit about the broader regional economy. So in order to measure economic activity, we calculate indexes of coincident economic indicators, and this is just a summary measure that allows us to measure the peaks and troughs in the regional economy. And what this chart shows is that the trends that were more or less underway at our last press briefing in June continued through August. So in particular, New York City was on a strong growth trajectory, and that continued beyond last press briefing. New York State and New Jersey were on a bit more moderate growth path, and that's also continued. In New York and in Puerto Rico, which has been in much longer long-term decline, what we saw at the last press briefing was there was some leveling out in 2012 and a sharp decline that was underway, and that sharp decline has continued. Now notice here, we can only calculate these indexes up through August. And that's because the information we need, in particular the employment data necessary to calculate these, wasn't available because of the government shutdown. So what I'd like to do now is give you a little bit of a sense for what you might expect using some other indicators that are available beyond the August timeframe and a little bit more up to date. All right, so the first thing we can look at is weekly initial jobless claims, which come out on a weekly basis. And basically what this is showing is that while there's some ups and downs in the weekly jobless claims, if you were to take an average up through the point that we've got information for and extend that out, the weekly jobless claims, in September, October, and early November really have been more or less on trend with what we saw prior to that. A second measure that we can look at is regional consumer confidence, and in particular, this is the present situation index for the Middle Atlantic states, which includes New York and New Jersey. And research we've done here at the Fed shows there's a high correlation between consumer confidence and employment. And what you can see here is that since really 2010, even though on the month-to-month basis, consumer confidence does have some volatility to it, the underlying signal has been a clear upward trend. And again, if you just focus on this most recent time period, the period for which the employment data is not available, you can see that even though the consumer confidence measure has fluctuated some, the underlying signal is consistently upward trend growth. And so if you step back and look at these two pieces of information, it suggests that the trends that were underway that we were able to show at the last briefing have more or less continued through early part of November. All right, so what about the jobs recovery? While the region overall has seen growth, there's parts of the region that have actually experienced a very robust recovery, and there's actually some places in the region that really have got no recovery whatsoever. So in terms of the places that have had a robust, strong recovery, places like Long Island, New York City, Glens Falls, Ithaca, these places have more than recovered the jobs that were lost during the recession. Some places that are a little bit ahead of the U.S. have recovered at least 75% of the jobs, Buffalo, Rochester, and Albany. While it's true that these places during the recovery have had a slower growth pattern, the recession itself was less severe there. And so as a result, up till this point, in terms of the recovery, these places are a little bit ahead of the U.S. There are still, though, many places in the region with a weaker recovery, in part because of either deeper downturns or slower job growth in the Hudson Valley, northern New Jersey, a few places in central New York. And then lastly, there are a few places in the region where there really is no sign of recovery. So I've already talked about Puerto Rico, but it's also the case that in Utica and Binghamton, really there's been no trough. In other words, jobs have continued to decline beyond the recession. All right, let me wrap up here with a few thoughts on housing markets. So what I'm showing you here is a home price index for the U.S. overall. And through the end of 2011, compared to the peak in March of 2006, home prices in the U.S. fell a little bit more than 30%. But since then, there's been actually a pretty robust housing recovery underway nationally. Home prices have increased 22 consecutive months and are now up about 20% relative to that trough. The picture here in the region, though, is a little bit different. So starting first with northern New Jersey, which was really one of the harder hit parts of our region, you can see that home prices didn't decline quite as much through the end of 2011, but really showed no real sign of rebound until recently. And so as a result, over this more recent recovery period, home prices are only up, are relatively flat compared to the national pace. Very similar picture in downstate New York. Home prices didn't fall quite as far through the end of 2011, but really a very modest recovery underway since then. And of course, in upstate New York, a very different housing experience. There really was no bust. Home prices were basically flat through the end of 2011 and have now just seen some modest increases. So where are the home prices actually increasing fast? Well, if you take a look at the U.S., there's this adage in real estate, all real estate is local. There's a very, unique dynamics going on at the metropolitan area level. So what I'm going to do here is break the roughly 380 metropolitan areas up into a couple groups. The first group are the metropolitan areas where home price appreciation is actually faster than the national pace. And what you can see here is that where home price appreciation is outpacing the U.S. pace is more or less in the places where the bust was most significant. So in the Sand States, California, Nevada, Arizona, in Florida, And then also in Michigan, where home prices declined quite substantially during the housing bust. The typical experience, which is the experience that most of the places in our region have, is that home price appreciation is actually below average. And in fact, there are some scattered signs of house price declines that are continuing even through the housing recovery that's happening more nationally. Right, and here in our region, one of the reasons we suspect that home prices are increasing at a slower pace has to do with foreclosures. And so let me end by giving you an update on the foreclosure picture here in the region. So just in order to set the scene, this is the U.S. trend. And with the housing bust and the Great Recession, you can see that foreclosures rose significantly, up to about 4% in 2010. And by 2012, when the housing market started to see some recovery, the foreclosure rate began to fall and has actually fallen pretty substantially nationally by about 25%. The picture here in our region is quite different. Even though the region was spared the worst of the housing bust, because of our very long foreclosure process, we've now built up a backlog of foreclosures well beyond what exists in the nation. And this has implications for putting a drag on home price appreciation. At the last briefing, we raised this, and since then, what you can see is even though foreclosures have stayed above the national rate, we've actually seen a little bit of relief there. Right? So this is something that we're going to pay attention to going forward. So overall, just to wrap things up, across most places in the region, the recovery has continued at a moderate pace.